All right, guys. Wish you all a very, 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 very happy Diwali. The very shows our enthusiasm for Diwali this time around. What makes Diwali special this time around is that apart from the usual festivities of Diwali, in our special offer for US CMA students, we are offering free MCQs a day, 4 MCQs on Monday, Wednesday, Friday for part 2 of US CMA, and 4 MCQs on Tuesday, Thursday, and Saturday for part 1 of US CMA. Now, this shooting pertains to our second and third day of US CMA MCQs. The questions of these MCQs have been loaded on our WhatsApp group. Kindly make sure that you are on the WhatsApp group to receive all the superb notifications that we share for USCMA. We have also shared a list of important essay questions this time around for September-October exam window of 2024. And yes, these essay questions have appeared in the examination till as late as 23rd of October examinations that were conducted. Two questions that we had predicted were certainly going to come, and they had come. One had come for functional currency and reporting currency, and the other one was with respect to a capital budgeting or an investment decision question. So yes, the predictions are going right. The responses for students are coming positive. Let's deep dive into today's MCQs. Today's MCQs of part 2 of USCMA focus on the chapter investment decision, enabling you to have a quick revision of the concepts of this chapter. Let's take a look at question number 1. A company is considering a purchase of 5 construction cranes for its recently awarded construction project. What makes this question special is that you're not looking at the purchase of one, but you're looking at the purchase of 5 cranes. The cranes cost $20,000 each. So we are looking at 20,000 multiplied by 5, which is equal to $100,000 of a capital outflow. These cranes are projected to provide a total cash saving of 1,90,000 over the next 8 years. This is where students get confused. The term used here is not cash inflow. They are using the term cash saving. This is where you have to understand and agree to the concept that savings here are to be treated as an inflow. Savings here are the benefit that arises from the use of this particular asset, owing to which 190,000 in all over the next 8 years is what you are going to earn in total from this investment. Now, 5 cranes for 20,000 each means 1 lakh rupees is your outflow. This is your present value of cash outflow, and 190 over the next 8 years. So generally, if you had a discounting factor, you could certainly do NPV over here. But now they are saying that the projected cash savings are given to year on year basis, and they are asking you what is the payback period the closest to. Rather easy question. Now, how do we do this? We put down the year first of all. Year 0, 1, 2, 3, 4. Now let's talk about the cash savings. What are the cash savings? For the first year, the cash savings are nil. So the cumulative savings are also nil. Cumulative means total so far. At the end, now of course, year 0 means the first day of the year. So don't get confused why it is like that. We have purposely written this. You can also draft this out. It's not going to make too much of a difference to you. Year 0 means the first day of the year on which the asset is purchased. So obviously the cash saving has to be nil. You're not going to have a cash saving. You're going to have a cash outflow on that particular day. You need to understand this concept. So at the end of year 1, you have a cash saving of 35,000. So till the first year end, the inflow is 35,000. In the second year, you have 32,000. In the second year, 32,000 means total until now will be 35 plus 32. The total until now will be 35 plus 32, which is 67. So far you have got 67 total, and in the second year only 32. The third year it is 28,000. So we are looking at 67 plus 28, which will give us a total of 95,000. So 3 years total is how much? 95,000. Third year only is how much? 28,000. Now in the fourth year we are getting 26,000. So 4 years total is 1,21,000, and the fourth year is 26,000. When I teach payback period, I generally stop the calculation here. Why? I want one cumulative frequency. I want one cumulative frequency that is more than the total investment. What is my investment value? My investment value is 1 lakh. I want one cumulative frequency above the investment value, and I want one immediately before that cumulative frequency, which has to be less than the investment value. This shows that at the end of year 3, 95,000 has been collected. So here I am writing down cost of investment. What am I writing down? I'm writing down cost of investment is equal to 1 lakh. Next, I'm writing down recovery up to year 3 end is how much? Is 95,000. My dear friends, up to the third year, you have recovered $95,000. So, what is the balance to be recovered? The balance to be recovered is $5,000. What is the recovery? What is the recovery of year 4? Sir, it is $26,000. Somebody will by mistake say 121. 121 is not for year 4. It is total collection of 4 years. 26 is collection of 4th year. In Hindi, if I was to explain this, I would say कि टोटल 4 साल में 4 सालों की 4 इयर्स की कलेक्शन 121 है और 4th ईयर की चौथे साल की 4th ईयर की चौथे साल की कलेक्शन 26,000 है. 4 इयर्स की कलेक्शन और चौथे साल की कलेक्शन are two different concepts. Collection for 4 years and collection of the 4th year are two absolutely different concepts. So my dear friends, if I was to take a look at this, it shows me that in 1 year I am recovering 26,000. In how many years will I recover? Of course 5,000. It's a simple question. In 1 year I am recovering 26,000. What part of the year do I need to recover? 5,000. So the answer is obviously 5,000 divided by 26,000. It comes to 0.192. It comes to 0.192. So if it takes you 1 year to recover 26,000, it will take you 0.192 years to recover 5,000. So recovery up to the third year end is 95 and recovery after 0.192 years is 5,000. So your payback period is 3 years plus 0.192 years. It is 3.192 years is your payback or your recovery period. This can be rounded off to 3.2. This can be rounded off to 3.2, making 3.2 the answer in your question. Right? So payback period is about when the collection is going to be recovered. Sir, why didn't you write down this? Why should I do this? This is not a CA inter examination where your presentation has marks. This is US CMA MCQ based examination. You just have to calculate the right answer. You don't have to make any presentation. It's a computer based MCQ exam. So chill out, guys. We are on the right track. Next question. Interesting question. A company requires that the capital budgeting proposal, meets the acceptability criteria of both payback method and net present value method. What is the acceptability criteria of payback method? The payback has to be in certain period. So there is a cut-off payback period that they are using, that is of 4 years. That is of what? 4 years. Means it shows clearly if payback period is less than 4 years, you will accept the project. If payback period is greater than 4 years, you will reject the project. So let us analyze the project on the basis of payback. So let us do a payback analysis. It is 5 years, so you are going to reject. It is 3 years, you will accept. It is 5 years, you will reject. It is 3 years, you are going to accept the project. They have not said anything about NPV. Boss, you don't need anything to be said about NPV. For NPV, there is only one criteria. If it is positive, you will accept. If it is negative, you will reject. So let's look at NPV over here. In NPV, we have 8 lakhs positive. So we are going to accept. Over here, we have NPV positive. We are going to accept. Over here in project C, we have NPV negative. We are going to reject. In D, we have NPV positive 50,000. We will accept. Which projects will produce a conflicting result? What is the meaning of conflicting? One will accept, one will reject. Is there any such project over here where we are having one will accept, one will reject? Yes. We have project number A where one will reject under payback and we will accept under NPV. Owing to this, project A is going to produce the conflicting results. Project B is clearly resulting no conflict. Project C is clearly a rejected project, and project D is also clearly an accepted project. But project A is a damadol because as per NPV it is good, but as per payback period it is bad. So what should we do? Kare to kare kya, bole to bole kya, wah Modi ji wah, tell us what to do. Of course, tell us what to do is not a part of it. You have to look for the conflicting one. We have found it out. Let's go to the next one. The next one is a good one. The only thing that they have done over here is that they have included some, twist as far as the cash flow calculation goes. Let us see what they are saying here. They are saying Quint company uses payback period method as a part of its analysis of capital investments. One of its projects requires 140,000 of an investment and has the following projected before tax cash outflows. The effective tax rate is 40%. So if this is cash flow before tax, can I say that cash flow after tax will be 60,000 minus 40,000? So on your calculators, when you punch 60,000 and press minus 40%, you will get straight away the answer as 36,000. So cash flow after tax for the first 3 years is 36,000. For the fourth year, it will be 80,000 minus 40%, where you can see that it is 48,000. Where you can see that it is how much? Where it is 48,000. Now what we want, oh, 1 second, this 48 is not written over here clearly. So let us just write it clearly so that everybody understands. This is 48,000. Now I need cumulative after tax cash flows. I need cumulative after tax cash flows. So cash flow for the first year is 36. Total cash flow at the end of the first year is 36,000. Cash flow for the second year is 36. Total cash collected for 2 years is 72. Cash flow for the third year is 36,000. Total cash collected at the end of 3 years is 1,08,000. Cash flow for the fourth year is 48,000. Total cash collected now is 1,56,000 in 4 years. I will not go beyond this because I need to recover only 140 and over here my recovery is happening of 156. We'll just write this in a more neat manner. Recovery is happening of how much? Of 1,56,000. Now, I know that before the end of year 4, my recovery is happening. So it is between year 3 and year 4. The recovery is between year 3 and year 4. At the end of year 3, the recovery is 1,08,000. So my balance, now see what is the cost of the asset? The cost of the asset as far as we are concerned is 1,40,000 minus recovery up to year 3 minus recovery up to year 3 is coming to be 1,08,000. So what is the balance to be recovered? The balance to be recovered is $32,000. Now, what is the recovery of the fourth year? Please understand that in the fourth year, we are earning after tax 48,000. For the fourth year, for that 1 year, the fourth year, your cash flow after tax is 48,000. For the fourth year, of the fourth year, the cash flow is 48,000. Of all the 4 years put together, the cash flow is 1,56,000. चौथे साल का कैश फ्लो 48,000, 4 सालों का मिला के 1,56,000. So the balance to be recovered is 32,000 and the recovery in year number 4 is how much? 48,000. So in 1 year you are recovering 48,000. What part of it do you need for 32,000? Your answer is simple. It will be 32 divided by 48, which is equal to 0.66666. Now you will notice in this particular question that they are doing up to 1 decimal. They are doing up to 1 decimal. If you notice in the answer, they are up to 1 decimals. So if I have to round this off, I will round this off to 0.7. Therefore, what will be my payback period? Up to year 3 means year 3 is over here. Year 3 years plus 0.7 years. So my payback period becomes 3.7 years. What is my payback period? My payback period for Quint and Company is 3.7 years. We need to look for that as the answer. And let us go here and see that we have got the answer 3.7. For all the students taking notes, please note down or take a screenshot. Please note down or take a screenshot of these workings because these workings will be useful for you for making your notes. We are focusing on the Jan Feb 25 window. So please make sure that you are doing your level best and making the right notes before you are able to, go ahead. We have got a shooting of the cricket match going on in the background for our students as a Diwali thing. And it seems that one of the players is out. No. So Virat Kohli is batting with Washington Sundar, if you need to know. And so far, so good. So we are all praying that we win the test match, and we are also curious to understand what is going to be Lawrence Bishnой's next move against Salman Khan. So if anybody knows what Lawrence is going to do next, please tell us, because in Mumbai over here, we do like Mr. Salman Khan a lot. All right. So now let's go to the last question. I believe last or second last. Okay, this was the second question. So we have one question over here. Very interesting question with respect to a mixture between IRR and NPV. See, students, let me clarify the concept of IRR over here for you. See, please understand this funda before you go ahead. See, internal rate of return is what the project actually gives you, is what the project actually delivers as a return. Please understand that. And the discounting factor is your cost of capital, means it is what is expected by you. Please keep in mind, if you expect 18% and the project is giving 20%, here you will accept the project because your actual is greater than your expectation. If your expectation is 18% and the project is delivering 14%, you will reject the project because your expectations exceed what is actually there. And if your actual is 14% and your expectation is 14%, still I will say that you can either be accepting or you can be indifferent, because it is the same. I would always say accept the project because you have the ability to build up a new customer. So always keep in mind, IRR, if it is greater than discounting factor, what you are going to do is you are going to accept the project. At IRR, present value cash inflow is equal to present value cash outflow. Therefore, please keep in mind that this is that particular cash flow where the business breaks even. This is the break even point of investment as far as you are concerned for cash flow calculations. Therefore, always keep one thing in mind. If IRR is greater than your discounting factor, accept, because discounting factor is expectation and IRR is what is the actual reality. IRR is what is the actual reality. You have to keep this concept in mind as far as IRR goes. Please write this down, pause the video, write this down well. This is going to be important for your understanding. Now let's jump into the question. What is the question? Diane Harper, the Vice President of Finance of BGN Industries, is reviewing material prepared by her staff prior to the Board of Directors meeting, at which she must recommend one of the 4 mutually exclusive options of the project line. Please understand, one of the 4 mutually exclusive means only one can be selected, The summary information indicates the initial investment required, the present value cash inflows, excluding the initial investment, at BGF's hurdle rate of 16%. This is nothing but your discounting factor. This is also your cost of capital. It can also be referred to as hurdle rate. The internal rate of return for each of the projects is given to you below. Now, please understand, over here, internal rate of return is equal to 15%. Now, if I was to say here that discounting factor, of course, will be 16%, 16%, 16%, and 16%. For the basis of IRR, here your IRR is less than discounting factor. On the basis of IRR, reject. This is on basis of IRR, you will reject. Over here, IRR is greater than discounting factor, you are going to accept. Again, IRR is greater than discounting factor, you are going to accept. Again, IRR is greater than discounting factor, you are going to accept. How much more it is, that is not the question. It is more than discounting factor, you are going to accept. The problem is, now as per IRR, there are 3 acceptances. Now what should we do? Now kare to kare kya, bole to bole kya. If there are no capital budgeting constraint, which option should Harper recommend? Harper, that is Diane Harper, what should Harper do when she is going to recommend? Now she is stuck between 3 projects. Now Harper will take the help of NPV. For Harper, what she will do? She will do present value cash outflow, that is investment, minus present value cash inflow. This is present value cash inflow. Now, in the first case, there is an outflow of 39,50,000 and an inflow of 38 8 lakhs. So you can see 39 lakh 50,000 minus 38 lakhs. What we are getting is negative 1 lakh 50,000 with NPV. When NPV, I just explained to you, if NPV is negative, what do? You reject the proposal. If NPV is positive, you accept the proposal. Therefore, in this case, both the cases, your final decision over here is going to be to reject the proposal. Why? Because IRR also fail and NPV also the project is a fail. Now look at project Y. Project Y, outflow 30 lakhs, inflow 3750. So NPV is plus 7 lakh 50,000. In the second case, 20 lakh, 28 lakh, 25,000. So here I can see that the NPV is plus 8 lakh and 25,000. And here I can see 8 lakh and 11 lakh. So I can see that plus 3 lakh 10,000 is equal to the NPV. My dear friends, here it can be clearly noticed that the highest NPV is 8 lakh and 25,000. This project Z delivers the highest positive NPV of 8,25,000, and on the basis of IRR also it is an acceptable project. So on the basis of NPV, I will select Z, and as it is, Z has been selected on IRR basis. So since IRR was not able to give me the right answer, or IRR was able to not finalize one answer for me, I had three options as far as IRR was concerned. So I selected all the three in IRR. I said, chalo, all three are good, but NPV now helps me to identify the one with the highest NPV, which is 8,25,000, and I select 8,25,000 as the highest NPV and the positive IRR. Therefore, I select project number Z for this particular project. Please ensure that this is copied down in your notebook. Pause the video now. Pause it. Write this down or take a screenshot and ensure that these notes that I'm giving are of retention to you. So we are selecting project Z over here. So go for the highest. We are going for project Z. We are going for project Z. With this, we have finished the 4 questions of part 2 of US CMA that we were supposed to do on day 3. Stay tuned for the other day's video. We are keeping the video short in length so that quickly you can revise and you can watch all these videos in quick succession instead of watching one huge video. Immediately stay tuned for the next day's shooting. It's coming to you shortly. Thank you so much. Best of luck. Subscribe to Apex Academics for updates like this on your MCQs. Join our WhatsApp group and keep following us for more and more MCQs. Thank you so much. Best of luck. Happy Diwali.